Hey everyone, how you doing today? One of the things I love about all my experts on our expert series Monday through Friday is they actually care about helping you. And in this instance, we have our normal Monday guest who reached out to me this morning saying, "Hey, did you see this thing from the CFPB Consumer Financial Protection Board? We got to talk about it. It can't wait till next week." And I'm like, "Dude, you're awesome. Let's talk about it." So let's welcome Greg to our Thursday, which is normally Monday, but how you doing, buddy?
Doing good. Thursdays with Michael.
You have no idea how much I appreciate Mondays with you and your willingness to say, This is a hot topic. Let's share ideas." So thank you very much.
Yeah, man. Yeah, happy to be here. And yeah, the Consumer Financial Protection Bureau. Yeah, they've got this new proposal that they put out that they're looking for comments back on about how to help people that are in the forbearance program, potentially facing foreclosure. So there's a lot of things in there that I thought would be beneficial to your audience. Who knows who's listening, whether they're in trouble, in forbearance, need help. So, or if you're an investor looking, for opportunities, it's going to affect both worlds. It's going to affect investors and owner occupants.
Yeah. I think we can talk about all of that. And then I actually think one of the largest unintended consequences, there's actually so many of them. It's actually when you think out to the future, maybe we'll do a couple episodes here. We'll do one talking about people in forbearance and investors that were expecting supply. That's going to be episode one. Then we'll shut it down. And then episode two is going to be about, let's think out a year, 2 years. What could the unintended consequences be? Because I think those are both equally important. But so let's give
Yeah.
each their due. So let's break it down. Let's talk to investors first, because Greg, you and I try to help. You and I have been battling this storyline that there's going to be a crash. Everybody was pointing at Black Knight, talking about 3.2 million people in forbearance. You and I have tried to beat that horse, saying it's not coming. Well, I think it's official. It ain't coming with this announcement. Don't you think?
Oh yeah, absolutely. I mean, we said all along the government was going to step up. They're not going to let another 2009 happen again. And that's exactly what they're doing. They're stepping up. They're backstopping this as they should be,
Hmm.
helping people that need the help. So it's going to continue. So what they're talking about, number one, is extending the forbearance to the end of the year.
Hmm.
That's number one. Number two, for people that aren't in forbearance, you can't even start the process of a foreclosure for 4 months, or default. Number three, they're talking about potentially offering a 40-year mortgage option, but that's only for government-backed mortgages. That doesn't, affect, the commercial markets, which, or public, private markets, not the public markets.
Hmm.
And that's the other thing we'll talk about on the other side. How is this going to affect, the private industry of mortgage lending?
For sure.
But so those are some of the things. So that's really great. That's just saying, hey, if you're in trouble, you've got till the end of the year to figure this thing out. They're also, providing relief in terms of what you need to provide for your application. So they're lowering the bar in terms of the information and documentation you need to provide to show that you're actually in distress, that you've lost income. So, they're basically, sounds like they're going to set up an online portal where you check some boxes and you can extend everything and, get a loan modification.
Yeah. Yeah, the term for the year, right? If you remember, you'll remember this. I don't know if the audience will remember this, but back in 2009 and 10, the word of the day was strategic default, right? You're
Hmm.
like, you could pay, but it was not financially wise to pay. So you mailed the keys in, essentially, right? The word of the day for 2021 and 2022 is going to be avoidable foreclosure. So
Yeah.
what I really saw in that documentation, I've read it a couple of times now, basically almost nobody is going to be foreclosed on. I mean, I originally thought 20% ish. I'm now
Hmm.
thinking 4 or 5%. It's going to be a big nothing burger. And oh, by the way, it's not to the summer of next year, best case. So if you were
Hmm.
looking for inventory to show up, it ain't coming.
Yeah, they've just given everybody a break, so you don't have to make your house payments. It's very low bar in terms of qualification for that program, and then, like you said, they're but there is an out for mortgage companies and servicers to foreclose if people aren't responding, if the
Mhm.
house is abandoned, vacant, those types of
For
things.
sure.
So there are going to be some, but yeah, everybody, the Ken McElroys of the world who are all talking about, this housing crash that's
Not
coming and all
happening.
that, we've said all along, the government, the Fed, they're not going to let it happen.
Yeah.
And even if it did, I mean, even if you put 2-3 million units out there, we'd be back to a normal inventory level, and they'd all get snatched up from everybody looking for houses right now. So we've said that all along. Um, so yeah, I think that theory has been squashed.
All right. So the supply's not coming. That's part one of our first interview or our first discussion. The other one is, hey, if you're in forbearance, right? If you're a homeowner or even an investor, because you could be an investor in forbearance.
hmm
Um, what does this mean to them? What are your thoughts on that set of the equation?
Homeowners, it's great news. So you've got a lot more time, a lot more ability, and more appetite and availability of a loan modification at the back end. So just because you're in forbearance doesn't mean that you don't owe that money. You still owe that money. Now, here's the other thing: they're not charging interest on it. So the proposal is negating the opportunity or ability for servicers and investors to charge interest on those back payments. So now they're saying not only do you not have to make your payments, there's not going to be any interest, and we're going to basically guarantee you that you're going to get a loan mod at the end if that's your desire, and it should, the whole goal is to lower your payment. So
Yeah.
there's some restrictions. So a loan mod can't increase your payment. It cannot increase your loan term beyond 40 years. So there's some caveats to that, which is good. It's protecting borrowers, which is what this bureau is. The real question is, what is their ability to actually enforce this with, the private markets, the public entities, Freddie, Fannie, FHA, VA loans, they can do that there, but private mortgage markets, we don't know if they're actually going to be able to do this. So it'll be interesting to see how that all shakes out, what the challenges are there, and I guess we'll talk about that more on the other side. But there may be some resistance and opposition from the private mortgage markets on a lot of this, but everybody so far is stepping up to the table and saying, look, we want to keep people in their homes, we want to work these loans out. The government's going to have to just basically send money to these private investors, which are life insurance companies, pension funds. Those are a lot of where the money comes from in the private mortgage industry. It's not so much hedge funds or equity funds, it's more life insurance, pension funds, that are providing these mortgages through a servicing company. So the government can't just step in and say, oh, by the way, we're going to change this mortgage contract that you have, between your borrower and this investor. So that's a legal thing that's going to create a big problem. The government just can't come in and do that. But we'll see how that all shakes out and how those investment funds are compensated if they do participate.
Yeah. The other thing that we just have to talk about in part one of this episode is I when I looked at this, and I had to go through it a second time because I was kind of emotional, right? I'm like, oh my God, where did the free market go? But you got to step back and I guess appreciate what's going on. So they're going to position this as helping the homeowner. I mean, that's how it's all
Yeah.
going to be marketed, right? Um, but here's the reality: who it really helps is it helps the banks, and it helps the Fed, who's been buying all these mortgage-backed securities. Because I invested through the last crisis, and once the dominoes started falling, yes, homeowners lost their homes. They took a hit. But you know who really took the hit? It was the people who were writing off 80% of their loans. They took, the biggest hit. So really what banks are doing now is self-preservation. They want to they just want to get to the other side of this, call that timeout so they're not crushed this time. Banks are just doing exactly the opposite of what they did last time. Last time didn't work. Last time was a lot of pain. You know what? Let's try to do it completely different this time. Let's work with everybody. Let's make it extremely easy. No more strategic defaults, because if that happens, then prices fall and all hell breaks loose. So I think it's cute that they're positioning it as, oh, let's help the homeowner, but let's not be fooled. They're helping the banks.
Well, I think it is helpful for the homeowner because, there are a lot of people that are in real distress that lost their jobs. I mean, you got a big, I don't know. I think Powell said the effective unemployment rate was 10% or
Mhm.
something. I'm telling you, it's still around 20%. There's a lot of people that have exited the workforce,
Yeah.
that just quit looking. So it's still about 20% of the businesses are not operating that were operating before this happened. So there are good, honest people that have been hurt by
Oh,
this
for sure.
because the government said close your business, and we had this thing happen. So the moral question is, should they be helped? Should there be assistance? So I think the intent, again, good intentions are, number one, we got to help homeowners, but the overarching effects of what happened in 2009 by not working with homeowners, it took the banks out. Now the banks have already been propped up. Number one, free money. They've been
Hmm.
given the money to be able to go out and invest and speculate. So the banks have made a bunch of money that they're setting aside, expecting these write-offs. So they've already been given the ability to increase their leverage. Okay, they've been the amount of money that they can borrow based on their deposits. They've been given the ability to do that. A lot of them have been given the ability to trade. A lot of them have been given all these different vehicles to shore up their reserves to absorb some of these losses. So this is a situation where everybody's gotten hurt. The entire economy got killed.
Hmm.
A lot more people are being able to take more advantage of it than others just because of their position in the marketplace, whether you're on Wall Street or not, those types of things. There's still a lot of income inequality issues and things like that. But at the end of the day, I think the intentions are to help real people where they're hurting. What they still haven't done is they still haven't helped the businesses the way they need to. And they're starting to now, talking about forgiving the EIDL loans, forgiving the SBA loans, things like that, and offering more assistance and delaying those repayments and stuff like that. But at the end of the day, if you were a business owner that was put out of business, that generally, for most of you watching or listening, or people that or the businesses you used to frequent that are now closed, those people have not been made whole. The employees, the business owners, none of them. And
Yeah.
that's where the government has failed to really, stimulate the economy. When you talk about stimulus and infrastructure spending, this is not an infrastructure bill. There's a whole bunch of hundreds of billions that are going to green energy initiatives that aren't going to create a job, that aren't going to, supply infrastructure repairs and restoration that's needed right now. So there's a lot of things out there going on. But I think at the end of the day, the heart of all this is to help the homeowner. And again, there's a lot of collateral, opportunity and damage that's going to go along with it.
Yeah. You know what? I think you're right. Clearly in my earlier talk, if it came across that we weren't helping homeowners, that wasn't my intention. Absolutely, homeowners are being helped. And I think you're right. That's the heart in this equation. But the
Mm-hmm.
mind in this equation is, oh my God, we better protect the banks. Because we can't do what we did last time. That was too painful. That's a non-starter. We're not doing that again, right? Kind of the mind and
Yeah.
heart thing. And then the other thing I just hit me is I've been reporting on banks taking huge reserves for bad debt.
Mm-hmm.
Remember that in Q1, Q2 of last year, $5, 6, $8 billion. I think Wells Fargo had $8 billion set aside for bad debt.
Yeah.
Well, guess what? I'm an accountant. Most of that's coming off, which is going to
Mm-hmm.
impact their earnings to the positive. You're going to see
Right.
monster beats in the financial institution when the reserve for bad debt never happens. It's kind of crazy.
Right.
Yeah, this
Yeah.
is.
It's interesting times.
Mhm. Yeah, go ahead.
Yeah, it's interesting times. And, that's the one thing that they learned last time. The housing market almost took down the economy.
It
So
did.
they cannot let the housing market fail, which means you can't let the banks fail. The problem is they let Main Street fail, and that's where they messed up. And they should have stepped up. And they say, oh, we didn't have an efficient way to help, the average small business owner. That's just ridiculous. The EIDL loans that went out, could have easily gone out at more scale to help a lot more business owners. And it's but we're getting there. It's coming back. Businesses are reopening. Hopefully we can get everybody vaccinated and get this whole thing behind us, and help people that need the help, and get things moving again.
Very cool. I look forward to episode number 2, because this is where we're going to put on our thinking caps and look a year out, because I suspect there's a couple of surprises lurking. So thank you very much, Greg.
Yep.